Understanding financial risk. Understanding financial risk is crucial for any institution involved in the financial sector, such as banking, insurance, or investment. Financial risk refers to the potential for loss due to factors like market volatility, credit issues, or operational failures. Traditionally, financial risk management has relied on standard statistical methods and scenario analysis to predict and mitigate risks. However, technological advancements, particularly in machine learning, are revolutionizing financial risk assessment and management. The role of machine learning, a subset of artificial intelligence, utilizes algorithms trained on data to make predictions or draw conclusions. In financial risk management, machine learning can swiftly analyze vast amounts of data, identifying patterns and insights that may be overlooked by human analysts. This capability makes it an invaluable tool for financial institutions, enabling them to evaluate and respond to risks promptly and accurately. Credit risk modeling and assessment credit scoring is one of the primary functions of machine learning in financial risk management. Traditional credit scoring models rely on a fixed set of criteria to assess a borrower's likelihood of default. These models can be rigid and may not account for non-traditional factors influencing a borrower's creditworthiness. In contrast, machine learning models can continuously learn and adapt, considering a broader range of variables, including transaction history and social media activity. This results in more accurate and comprehensive risk assessments.
Stocks, currencies, bonds, commodities. The stock market has become a giant casino where traders are buying and selling non-stop.
Market risk management machine learning significantly impacts market risk management, which involves potential losses due to shifts in interest rates, market prices, or currencies. Machine learning models, particularly those involving time series analysis and complex derivative pricing, can forecast market movements and volatility more precisely than traditional models. Deep learning algorithms can analyze historical price data, relevant financial news, and macroeconomic indicators to predict stock price trends effectively. Operational risk management. Operational risk arises from failed internal processes, people, systems, or external events. Machine learning algorithms can track and examine various operational data points in real time, including transaction patterns and employee behavior. By identifying anomalies that may indicate risk, such as signs of fraudulent activity or potential IT system failures, institutions can proactively address issues before they escalate. Fraud detection machine learning is also crucial in fraud detection, a key component of financial risk management. Algorithms can identify complex behavior patterns indicative of fraudulent activities. Unlike traditional rule-based systems, machine learning does not rely solely on known fraud patterns. It evolves to detect new types of fraud as they emerge, making it essential in a constantly changing landscape of financial crime. Challenges of integration. Despite its advantages, integrating machine learning into financial risk management presents challenges. Data privacy and protection are paramount, as these systems often handle sensitive personal and financial information. Ensuring data security while complying with regulatory requirements is essential. Additionally, machine learning models can be opaque, leading to the black box problem, where stakeholders cannot easily understand the basis of risk assessments or credit decisions. Future of machine learning in financial risk management. The significance of machine learning in financial risk management is expected to grow. As techniques become more sophisticated and datasets richer, these models will become increasingly integral to financial operations. For institutions, investing in machine learning technology, talent, and infrastructure will be vital for effectively managing financial risk.
It was about 10 years ago that John Coates decided to quit the craze of the stock market.
Transforming financial risk management machine learning transforms financial risk management by enabling more sophisticated and efficient risk assessment processes. Its ability to manage vast amounts of complex data and continuously learn from it offers significant advantages over traditional methods. As these technologies develop, their integration into risk management strategies will deepen, reshaping how financial risks are managed in an increasingly digital world. Operational risk management techniques. Operational risk management is essential to an organization's overall risk strategy, especially in finance, manufacturing, and services. This risk involves potential losses stemming from inadequate or failed internal processes, systems, external events, or human factors. Effectively managing operational risks is crucial for minimizing losses, enhancing efficiency, and maintaining operational integrity. Operational risk can take many forms, including process errors, system failures, security breaches, fraud, and compliance issues. Due to this wide array of potential risks, organizations must adopt a comprehensive and proactive approach to identifying, assessing, mitigating, and monitoring these risks. Risk identification. The first step in managing operational risks is risk identification, which involves recognizing various risks that could impact an organization's operations. This process often relies on historical data analysis, expert insights, and risk assessment workshops. Advanced data analytics and artificial intelligence are increasingly employed to automate and refine risk identification. Machine learning models can analyze extensive operational data to uncover patterns indicating potential risk areas, such as frequent system outages or unusual transaction activities. Risk assessment.
AI and risk management in financial services cannot be overstated. AI brings immense processing power, allowing it to handle large amounts of data quickly and efficiently.
Following identification, the next step is risk assessment, where the identified risks are evaluated to understand their potential impact and likelihood of occurrence. This process frequently employs quantitative methods, such as statistical analysis and modeling, to estimate the severity of possible losses and the probability of risk events. Qualitative assessments, including expert evaluations and scenario analysis, are also critical, especially in areas where quantitative data may be limited. Risk mitigation. Once risks are thoroughly assessed, organizations develop risk mitigation strategies tailored to the nature of each risk. For instance, technological risks, such as system failures, may be addressed through robust IT infrastructure, regular system updates, and cybersecurity measures. Conversely, human error risks might be minimized through training programs, improved supervision, and streamlined processes. Effective risk mitigation can involve process changes, new technology implementations, enhanced human resource practices, or even restructuring business activities. Risk monitoring and reporting. Risk monitoring and reporting are continuous processes that ensure effective risk management over time. This involves regularly tracking key risk indicators, KRIs, that signal changes in operational risk. Modern dashboards and real-time reporting systems provide ongoing insights into operational risk profiles and alert management to potential issues as they arise. Frequent evaluations and audits are essential to assess the effectiveness of risk management strategies and to make necessary adjustments. Compliance and regulatory requirements. Compliance with regulatory requirements significantly shapes the operational risk management landscape. In many industries, particularly finance, organizations must maintain a formal operational risk management framework to adhere to regulatory standards. These frameworks typically prescribe specific risk management practices and reporting requirements, ensuring that organizations have adequate measures in place to handle operational risks. The role of technology. Looking to the future, the role of technology in operational risk management is expected to expand. As machine learning and artificial intelligence evolve, predictive analytics will become more sophisticated, enhancing organizations' capacity to anticipate and mitigate risks before they occur. Additionally, integrating blockchain technology into transaction systems can help reduce fraud and improve transparency. In summary, operational risk management is a vital practice that supports the stability and efficiency of any organization. By employing a systematic approach that includes risk identification, assessment, mitigation, and continuous monitoring, organizations can protect their operations from unexpected disruptions and losses. As technology continues to advance, operational risk management strategies will also evolve. Liquidity risk measurement and management. Liquidity risk arises from the inability to quickly sell assets at a reasonable price or secure funding. Given the complexity and importance of liquidity in maintaining financial stability, effective measurement and management of liquidity risk are paramount. Liquidity risk can be divided into two main categories: Market liquidity risk and funding liquidity risk. Market liquidity risk pertains to the difficulty of selling assets without significantly impacting their price, while funding liquidity risk relates to the possibility of failing to fulfill financial obligations due to an inability to obtain funding or liquidate assets. Regulatory considerations. Regulatory frameworks such as Basel III impose stringent requirements on liquidity risk management, emphasizing the importance of robust liquidity practices. Institutions must regularly assess and report their liquidity positions to regulatory authorities, demonstrating compliance with established liquidity ratios and risk management standards.